Are you looking to improve your credit score in 2024? Let's face it, a good credit score is like a golden ticket in today's world. It's the key that opens doors to competitive loan approvals, favorable interest rates, and even certain job opportunities. But how do you elevate that magic number? Well, it all begins with the concept of credit building, a journey that involves a series of thoughtful steps and strategic decisions. Throughout this video, we're going to break down these steps, explaining how each one plays a vital role in boosting your credit score. From understanding your credit report to manipulating balances and exploring options like credit builder loans and secured credit cards, we've got you covered. So buckle up and prepare to take control of your financial future. The first step to improving your credit score is understanding your credit report. This document is like a financial report card, providing a comprehensive history of your credit-related activities. So what exactly does a credit report contain? It lists personal details like your name and address, but it's the financial data that's really key. It includes information about your credit accounts, such as the type of account, mortgage, auto loan, credit card, the date you opened the account, your credit limit or loan amount, the account balance, and your payment history. It also records public records such as bankruptcies and tax liens, as well as inquiries about your credit. Now that you know what a credit report is, let's talk about why it's crucial to review it regularly. You see, your credit report plays a significant role in determining your credit score. If there's an error or inaccurate information, it can negatively impact your score. This is why you need to keep an eagle eye on your report. But what if you spot an error? Don't worry, you can dispute it. Start by writing to the credit reporting agency, outlining the specifics of any inaccuracies you've discovered. Include copies of documents that support your position. The agency is then required to investigate, usually within 30 days. Remember, this isn't just about correcting errors. It's also about being aware of your financial habits. Regularly checking your credit report can help you understand how your financial decisions affect your credit worthiness. It can guide you in making better choices in the future, such as paying bills on time or reducing credit card balances. In a nutshell, your credit report is a vital tool for managing your financial health. It's not just a collection of numbers and dates. It's a reflection of your financial journey, and understanding it is the first step towards improving your credit score. Remember, a well-maintained credit report is the foundation of a good credit score. The next key to boosting your credit score is making your payments on time. Now, you might be wondering, why are on-time payments so important? Well, payment history is one of the most significant factors that credit bureaus consider when calculating your credit score. It accounts for about 35% of your total score. When you consistently make your payments on time, it signifies to lenders that you're a reliable borrower. This reliability can boost your credit worthiness and, in turn, your credit score. But what if you're a busy bee and juggling multiple deadlines seems overwhelming? Don't worry, there are ways to ensure you don't miss your payments. Consider setting up automatic payments. This way, your payments will be deducted from your account without you having to lift a finger. Just make sure you have enough funds in your account to cover your bills. Alternatively, you can set reminders on your phone or calendar. This can be especially helpful if your income varies from month to month and you need to plan your payments accordingly. Remember, consistency is key. Even a single late payment can have a negative impact on your credit score. So aim to pay your bills on time, every time. Timely payments are a simple yet effective way to maintain and improve your credit score. Reducing your credit card debt is another crucial step towards improving your credit score. It's like doing a little spring cleaning for your finances. Let's dive into this. Think of your credit utilization as the percentage of your available credit that you're currently using. Credit card companies and lenders look at this number because it helps them gauge how responsibly you handle your credit. If you're constantly maxing out your cards, it sends a signal that you might be a higher-risk borrower. On the other hand, maintaining a low credit utilization ratio can positively impact your credit score. So, how can you lower your credit card balances effectively? First, make more than the minimum payment each month. This not only reduces your balance faster, but also saves you money in interest. If you have multiple credit cards, consider the avalanche method. It involves paying off the card with the highest interest rate first, while making minimum payments on your other cards. Once that's paid off, move to the next highest rate, and so on. This method can save you a significant amount in interest over time. Alternatively, you can use the snowball method, where you pay off the card with the smallest balance first, regardless of the interest rate, while making minimum payments on the others. This approach can give you a psychological boost and momentum to keep going. Another way to manage your credit card debt is by considering a balance transfer. This involves moving your debt from a card with a high interest rate to one with a lower rate, often even 0% for a promotional period, helping you save on interest payments while you pay off your balance. And finally, always try to avoid unnecessary expenses and impulse purchases. Create a budget and stick to it. This discipline will help you control your spending and prevent further debt accumulation. Remember, a lower credit card balance means a lower credit utilization ratio, leading to a higher credit score. So, take these steps to reduce your credit card debt and watch your credit score climb. Did you know that there are tools specifically designed to help you build credit? It's true, and two of these tools are Credit Builder loans and secured credit cards. Let's start with Credit Builder loans. This type of loan is specifically designed to help individuals build or improve their credit scores. Here's how it works. When you take out a Credit Builder loan, the lender places the money in a savings account. You then make payments over a set period, typically 6 to 24 months. The lender reports your on-time payments to the credit bureaus, which helps to build your credit history. Once the loan is paid off, you get the money from the savings account. It's like a forced savings plan that also builds your credit. Secured credit cards, on the other hand, require a cash deposit that serves as collateral and your credit limit. It's a fantastic option for those who can't qualify for a traditional credit card. Like a regular credit card, you use it to make purchases, pay off your balance, and incur interest if you carry a balance. The major difference is that if you default, the card issuer can use your deposit to pay off the balance. Now, it's essential to use these tools responsibly. That means making all payments on time and ideally paying off your balance in full each month to avoid interest charges. Remember, the goal is to improve your credit, not to get into more debt. Also, it's worth noting that these tools aren't a quick fix. Building credit takes time, but with consistent, responsible use, Credit Builder loans and secured credit cards can make a significant difference in your credit score over time. These tools, used wisely, can be a stepping stone towards a robust credit score. Remember, a good credit score opens up a world of possibilities, from lower interest rates to better chances at loan approvals, so it's well worth the effort to build it up. Improving your credit score doesn't happen overnight, but with patience and discipline, it is achievable. So let's remind ourselves of the key points that we've covered today. First, understanding your credit report is fundamental. Knowledge is power, and in this case, it's the power to identify errors that could be harming your credit score. Regularly checking your report allows you to stay on top of your financial health and take action when needed. Next, we talked about the importance of making payments on time. This habit can greatly influence your credit score, as it demonstrates your reliability to potential lenders. Remember, even a single late payment can have a negative impact, so stay consistent and punctual. Then we discussed reducing credit card debt. It's no secret that high balances can lower your credit score. By paying off your debts and maintaining low balances, you're not only improving your credit score but also freeing yourself from the burden of debt. And finally, we explored the use of credit-building tools like Credit Builder loans and secured credit cards. These instruments are specially designed to help you build or rebuild your credit. Use them wisely, and over time, you'll see a positive effect on your credit score. But remember, improving your credit score isn't a race or a competition. It's a journey that requires effort, time, and a lot of patience. Don't be discouraged by small setbacks or slow progress. Instead, celebrate each little victory along the way. After all, every step forward, no matter how small, is a step in the right direction. And always keep in mind that you're not alone in this journey. There are plenty of resources and tools available to help you along the way, like Experian services that we've mentioned earlier. So stay motivated, stay informed, and stay on track. Remember, every step you take towards improving your credit score is a step towards better financial health. Start your journey today.